Hi everyone, I'm Colin, Assistant Manager at the iFAST research team. So last year was a very brutal year for markets, an exceptionally tough year for investors' portfolio as well. I'm sure you guys know about it, but it is much more tougher for investors' portfolios that are heavily correlated to just a few asset classes. And on top of that, your equity bond correlation just went positive, and what that means is that whenever equity drops, your bond drops. So that made it even worse for investors, and then because there's no way to hide from the storm. But that said, this relationship has been easing, and the threat of a recession has once again thrust the portfolio diversification into the spotlight. So in this presentation, I will introduce a 4-step process that the audience can follow to construct a globally diversified portfolio. And with that, I also use our MAPS portfolio. For those who are familiar with which is our managed portfolio services, as an example to highlight step by step how it can be done. So right here you can see is an overview of the 4-step process to be used as a signpost to guide investors on asset allocation, the selection of underlying securities, and then most importantly, the risk management. So the first step of this process begins with inter-asset allocation, which is where a decision is made to determine which asset class to invest in. And there are many asset classes, equities, fixed income, cash, or even alternatives such as your commodities. But at FSM 1, our portfolio construction process utilizes 2 main asset classes, namely equities and fixed income. Because it is our opinion that a portfolio consisting predominantly of these 2 major asset classes will be sufficient to deliver a risk-return profile that can meet an investor's requirement. So here's a view of MAPS portfolio's neutral asset allocation. And you can see that we recommend investors to determine their fixed income as well as equity allocation based on their individual risk-return profile. So for example, an investor with a higher risk tolerance can assign a larger weight to equities and consequently a lower weight to bonds. So to show this, like I mentioned earlier, here's the neutral allocation for MAPS portfolio. And each portfolio has its own equity to bond split to accommodate the corresponding risk profile. For example, an aggressive portfolio which is designed for high-risk investors comprised of 90% equities and 10% bonds. And conversely, a conservative portfolio which is designed for lower-risk investors comprised of 90% bonds and 10% equities. So now let me briefly share with you our current inter-asset positioning for MAPS portfolio. So in the month of December, just recently, we have cut our equity overweight to a neutral weight. So we have reduced our equity positioning and raised our fixed income exposure. And for those of you who have attended the presentation earlier will know why. Because right now, we find that fixed income as an asset class is more attractive because it not only offers higher yields, but also the valuation-wise have turned much more attractive relative to equity markets. And we compare this by looking at the yield of global bonds relative to the earnings yield of global equities, which is the inverse of the forward PE. So this is being captured by the chart on the right, as you can see. And this ratio, which is the ratio of the global bonds yield relative to earnings yield, has fallen steeply. And in other words, this implies that there is now a greater value in bonds than equities, and at this current point in time, we think it is a good time to increase exposure to bonds. And in the second step, which is the intra-asset allocation, we believe investors need to decide which subsegments to invest in within each of the asset class. So the purpose of this is very simple. It is to enhance portfolio diversification and for the investors to express more granular views within the asset class. So there are multiple ways to segment an asset class further. For equities, some of the common ways include segmentation by size, by geographical regions, as well as by styles. And by styles, I mean your value, your growth, or your high dividend, or your low volatility equity markets. And on top of that, for fixed income, you can also segment them even further by market segments, geographical regions, as well as credit quality. So to ensure a well-diversified global portfolio, investors can consider allocating across major geographical regions. So here is a quick look at how we segment the MAPS portfolio geographically for both the bonds as well as the equity markets. But unlike the traditional market cap segmentation, we assign higher weights to emerging equity regions such as your Latin America, your Asia, as well as your EMEA. So there are two reasons why we do this in particular. One is to capture the growth of this developing region because we expect these regions to grow at a higher rate than your developed markets, and we want to position ahead to capture the growth of these high growth regions. And second is that many of these emerging markets companies are often under-researched, under-covered, and may offer potential alpha, and we assign higher weight to again capture that. And earlier I shared about our inter-asset allocation, so now let me share our intra-asset allocation. So for equities, right now, our MAPS positioning, we are overweight Japan and Asia ex-Japan. And in particular, Japan is a market that we are positive on, and it is our top pick within developed markets. And our overweight for the MAPS portfolio equity portion is funded by underweight in Europe as well as your digital economy stocks, which we are negative on. And we remain neutral on China, EMEA, Latin America, and the US. But aside from China, we are cautiously optimistic of the last three regions, and we have them on our watch list. And for fixed income itself, our preference is on the safer, higher quality, as well as the shorter duration segments, like global bonds as well as Singapore-centric bonds, which we remain overweight. And this overweight is funded by underweight from Asian investment grade, emerging market bonds, as well as global high-yield bonds. And we are more cautious on the latter two, which are the EM bonds as well as global high-yield bonds, entering a potential recession because of a less robust credit quality. And while we are neutral on Asia high-yield bonds right now, we remain very mindful and very cautious because we think that Asia high-yield bonds now come with a much higher risk than before. So moving on to the third step, which is to choose the appropriate investment product. And this may sound simple, but it's actually essential and very key to enhancing the risk return of a portfolio. So for both equities and fixed income, investors can consider assessing the product based on several different considerations. Firstly, performance, which includes the historical return as well as the consistency of these returns. And secondly, the expense ratio, which is often lower if it's better, but investors do have to consider what they are paying for relative to the returns of these products. So not just the expense ratio itself. And lastly, looking at the risk of those products. So this can be quantified by looking at some of the popular portfolio risk metrics such as your standard deviation, your maximum drawdown, as well as your downside volatility. And after this consideration, investors can also consider whether to assign to active investment or passive investment, which is a big question on its own. And active investment, or UTs, means investing in funds that are run by portfolio managers, and therefore they are more often more expensive. And on the other hand, we have passive instruments or passive investment, which are your ETFs, which refers to funds that replicate performance of an index. This fund often buy into the underlying index, mirroring the proportion, and as a result, they are more cheap than your active investments, which are your UTs. So let me show an example of a 50-50 equity bonds portfolio, and feel free to take a picture or to note down the recommended weights as well as the recommended fund here. So this is a model portfolio constructed with our MAPS portfolio's neutral geographical allocation, which I've showed earlier, and using our list of recommended fund. So this list of recommended fund is a list that we will review annually to pick out what best funds we believe represents a geographical region or a particular style. And for new investors, we do think that this is a good starting list of funds to consider. And also you can see that the fixed income sleeve itself is segmented by geography and credit quality, whereas the equity region is also segmented mostly by geography. And also through this, we are able to ensure that we are able to diversify globally as well. So now let us move on to step 4. So after constructing the portfolio, we believe it is beneficial to regularly monitor the underlying positions to ensure that each position stays within the range of the intended allocation. For example, if you assign a 5% weight to US equities and after US equities move wildly and the weightage of US equity moves to say 8%, then it is time to relook that allocation. And if the allocation shifts materially or shifts wildly, it is also good to rebalance the portfolio. And this is important as portfolio allocation, like I mentioned, tends to drift over time. And this leads to an unintended allocation in the better performing assets and the lower allocation or underweight in the worst performing assets. So this chart here captures the point. Let's say you construct a 50-50 equity bond portfolio on December 2019, so about 3 years ago, and you leave the portfolio alone without any rebalancing. So by the end of December 2022, by the end of last month, your portfolio would end up being 45% bonds and 55% equities, which is a significant drift from your intended allocation. So for investors, this means two things. Firstly, the diversification purpose that you set out to achieve is now eroded. And secondly, the portfolio's risk profile has also shifted, and the investors will end up being more exposed to the better performing asset, which often has a higher risk, and in this case, equities itself. So to further demonstrate the merits of rebalancing, this chart here shows the portfolio's performance of both a buy and hold strategy, which involves no rebalancing, compare that against a portfolio that is rebalanced annually. So you can clearly see from the chart right here that over the long term, the portfolio that is rebalanced annually managed to deliver higher returns of approximately 23% more. And even after accounting, for transaction costs, which we estimate to be roughly around 1.5% per rebalancing. And furthermore, you can see quite clearly that the portfolio that is rebalanced annually also demonstrated smaller drawdowns during most periods as compared to the one that is not being rebalanced at all. And let me move on to the other important risk management tool which I have highlighted earlier, which is portfolio diversification. In fact, the objective of diversification is to avoid concentrated exposure in any asset. So this can be achieved by several methods. Firstly, to invest across asset class, like I have highlighted earlier. Secondly, is to invest within the different segments of the asset class. And lastly, is to invest in assets that have little or no correlation with each other. And a diversified portfolio serves well to minimize losses, especially during sell-offs, and it is particularly effective in a downwards moving market, such as the one that we are in right now. Moreover, as shown on this table right here, rarely does one asset outperform or underperform consistently in today's changing macro environment. As you can see from the chart here, 2022, the top performing asset is Latin American equities, whereas over the last 5 years, you don't see that anywhere around the top few performing equities markets. So what this means is that if you have a diversified portfolio, you're able to not only minimize your portfolio risk, but able to have exposure to potential winners as well. So to further demonstrate the benefits of diversification, we backtested and ran the long-term returns of 3 different types of portfolios. Firstly, a global equity portfolio. Secondly, a global bonds portfolio. And lastly, a 50-50 equity bonds portfolio. And over a 30-year period, you can see that the global equity portfolio, which is denoted by the green line over there, delivered a much stronger returns, but at the expense of greater volatility as well as a fiercer drawdowns. And on the contrary, you can see that the global bonds portfolio, which is shown by the blue line here, showed lackluster returns, but experienced, in fact, half the annualized volatility as well as half the maximum drawdowns in the same period. And you can see that from the table right there on the left-hand side. However, by investing in both equity and bonds using a simple 50-50 split, you can see that the portfolio, which is shown on a pink line right here, can have the best of both worlds. In fact, the combined the 50-50 portfolio enjoys lower annualized return and lower maximum drawdown without significant trade-offs in returns. And as a result, it also enjoys a better risk-adjusted return as shown by a higher Sharpe and Sortino ratio. And just as a bonus, this 50-50 portfolio enjoys more months or saw more months with positive performance as shown on the percentage positive months right there. So based on this matrix, it scored really well. And what we wanted to say is that while the results may vary with the different equity and bond split, the conclusion is very clear. Just by diversifying across the asset class, and investors can not only enhance their portfolio's risk return over time, but also get exposure to potential winners. So alright, with that, I've come to the end of my presentation, but I will leave you guys with a summary of the 4-step process as well as our current inter and intra-asset allocation. So with that, I hope the audience have some valuable takeaways and from today's presentation. And thank you guys for your time and have a great year ahead.